restaurant construction loans for franchisees, and why owning your own building can often cost less than renting would. And for many restaurant franchisees, the default strategy has always been to lease a second generation restaurant space. And the logic seems simple. It already has the kitchen, the dining room, and the utilities, so opening should be faster. But what if buying your own restaurant pad and constructing a brand new facility actually resulted in a similar or even lower monthly payment while allowing you to build long term wealth and invest less money? With today's SBA 504 and 7A construction financing programs, you can get 85% loan to cost. And many franchise owners are discovering that owning the real estate may be the smartest business decision that they ever made. So, why franchisees continue to rent? Well, most franchise operators lease because they believe that construction is expensive and banks require massive down payments, and owning real estate ties up too much capital, and leasing's easier. While those assumptions were often true today, today's SBA lending programs have really changed that equation. So here's the hidden cost of leasing a second generation restaurant. And a second generation restaurant space isn't always a bargain. And many locations are still going to require a new HVAC system or hood modifications or plumbing upgrades or ADA improvements or electrical upgrades. But you still have your franchise branding requirements and parking lot repairs and roof repairs and landlord approval delays. And even after spending hundreds of thousands of dollars in tenant improvements or TI, you still don't own the building. And you're simply increasing the value of someone else's property. So why buying a restaurant pad makes sense. And purchasing land and building specifically for your franchise offers several advantages. One is you build equity instead of paying rent, and each monthly payment reduces principal while your property may appreciate over time. And instead of creating wealth for a landlord, you're creating wealth for your business. Design around your brand. And every major franchise is going to have their own unique specifications and brand requirements. And building from the ground up allows you to optimize, say, if you need a drive through layout or your kitchen efficiency or the customer flow or your parking or your patio seating or future expansion, but also lower long term occupancy costs. And in many markets, an SBA finance owner occupied restaurant can produce monthly occupancy costs that are competitive with or lower than leasing a premium second generation location. And the result is predictable long-term occupancy expenses without the uncertainty of lease renewals and escalating rental rates. So SBA 504, restaurant construction loans. And the 504 program is designed for owner-occupied commercial real estate. And typical benefits include up to 85% loan to cost, long-term fixed rate financing on the SBA portion, and fully amortizing loan structure with competitive interest rates. And these are ideal for established franchise operators. And these loans work well for fast food franchisees and casual dining and quick service or QSR restaurants or coffee shops or drive-through concepts or medical food concepts. SBA 7A loan program, and that's designed to provide additional flexibility. So it can be used to finance the acquisition of the land, the site development, the building construction, but also equipment, furniture, working capital, and soft costs. And this flexibility makes SBA 7A especially attractive for newer franchise operators or projects with additional capital needs. So, some eligible restaurant property types. Construction financing is available for many franchise concepts, including, say, a chicken restaurant or a burger concept or a pizza franchise or coffee shops or sandwich shops or Mexican restaurants or smoothie concepts or breakfast restaurants or an ice cream store or specialty food franchises. So, what do lenders want to see? Well, lenders typically evaluate the franchise experience, the management experience, personal liquidity, the credit profile, a business plan, franchise approval documents, and the project budget and construction timeline. And a strong development team and realistic financial projections can significantly improve your approval odds. So why work with a capital advisor? Well, every lender evaluates restaurant construction differently, and some specialize in restaurant construction or ground up development or SBA lending or franchise financing or only work with multi-unit operators. And rather than approaching one bank, experienced capital advisors can compare financing across a broad network of lenders to identify the structure that best fits your project. Final thoughts for the day. Restaurant real estate can become one of the most valuable assets a franchise owner ever acquires. And instead of spending years paying rent to somebody else, today's SBA construction financing programs allow many operators to build equity while controlling their occupancy costs. And if you're planning your next restaurant location, don't automatically assume leasing is the cheapest option. And I've been seeing it a lot recently. It's not. Owning may cost less than you think and create significantly greater long-term wealth. That is really it for the day. I'd love to talk to you more. I know a wealth of this particular topic, and I'm a resource to you. Please visit my website, billrapp.comloan.com. You can schedule a consultation so that way we could have a conversation, but you can also start a pricing quote there. Visit that website so we can talk more. Thanks for watching.